Good afternoon and welcome to this week's Halftime Talk, where in the middle of the trading week we take a time out to dig a little deeper into one of the trends that are affecting the international energy markets. And we're joined today by Unni Einemeo, Director of the International Bunker Industry Association. Unni, thank you so much for joining us.
Thank you very much for having me. It's my pleasure and my honor to be with you today.
It's nice to welcome you back to our table after 6 months when we last sat together at IP Week. As you said, it seems like many lifetimes ago, with so much has changed since then. And that's ultimately probably a good place to start. I can't start any conversation and say, how has COVID 6 months in impacted the international bunker market?
Oh, that's a big question. I mean, COVID 6 months in has had a number of effects. When it first started, we saw some of the initial problems around what happens in the ship and barge interface, as it were, when the supply is happening because of social distancing measures. So traditionally, during a bunkering operation, you might have the chief going on board the barge, or you might have the barge captain coming on board the ship. And there's exchange of documents and sampling, overviewing, and that kind of thing. There might be a surveyor involved. So that whole area was quite complicated for a while, because in a number of countries, they would not allow anybody off the ship onto shore, or anybody onto the ship, depending on which port you're in, depending on who's operating the ship, etc. So
which
some of that
still remains a major problem, with merchant seamen stuck on ships for months and months now. Yes,
absolutely. It's a big crisis in the crew change area. Many have been on board those ships way beyond their contract periods. We've seen it happening on barge operators as well, because barges are, after all, ships which are operated generally in a smaller location. But we have seen that issue for some of the barges operating in some ports as well, where the crew have had to work way beyond their contracted periods. So yes, so that of course, the whole practical side of things has been an issue. The human factor has been an issue for shipping in particular, more so than on the bunker supply side, but for shipping in particular. But in that whole interface area, they had to go back to, in some cases, they reverted to very old-fashioned methods of exchanging things between the ship and the barge, like a bucket in a rope down the side of the ship to pass documentation and sample bottles between each other. And some of them started to make use of more electronic means. You know, almost everybody has a mobile phone these days, so you can take pictures of things and send them by email or by messaging, etc. So I think one of the major things we saw was how quickly the industry adapted to a new way of working. On the trading side, you know, we're all working a lot online anyways these days, and very swiftly the industry adapted to working from home. Everything went online, meetings, negotiations, etc. So I think that went quite well. We adapted really quickly. But the bigger question of...
Before we got into this COVID trouble, obviously IMO 2020 was the biggest thing since sliced bread, as the saying goes, in terms of what this year was going to present. And when we last talked, there was the big debate as to whether the scrubbers, those who had chosen to embed scrubbers in their ships had won, or whether those who had chosen to proceed down the ultra-low sulfur fuel oil were winning. And of course, at the beginning of the year, it did look like the scrubbers were the big winners because of the price differential. How has it turned out through this? Now we're into the end of the third quarter. How do you assess the whole of the last 9 months with IMO 2020?
Well, it's very true that, of course, the IMO 2020, when we last met Sean, was the talk of the town. We were early days then in the transition, and COVID had begun to emerge as an issue, but not one. We didn't quite realize how big of an issue it was going to be at the time. This was in February, and during the early phase of the transition, things were pretty much, I would say, as expected with regards to how the scrubber economics was really, really favorable for having scrubbers. There was a massive price difference between compliant fuels complying with the 0.5 sulfur limit that came into force at the start of the year, and high sulfur fuels, which ships with scrubbers were still able to use compliantly. So initially, I mean, you have to remember that this is a market where a huge volume of fuel went from being allowed to be high sulfur to having to be low sulfur over a very short period of time. This is why the limit came into force on the 1st of January. Most ships operators were waiting for as long as possible to make the change, because the price difference was very high in the run-up to the 1st of January as well. And fuel is often the biggest cost in shipping, or in many cases it is the biggest cost, operating cost for shipping companies. So any savings that they could make there by pushing that forward for as long as possible, that was there. So you came into this situation where the market was trying to find the balance. For a while there, the high sulfur fuel was in oversupply, and then it started tightening up. But initially, there was a lot of high sulfur fuel available because those stocks were still available in the market. They were still in the supply chain. And the price difference was in excess of $300 per ton. So this was happy days for those that had already installed scrubbers before the 1st of January. And then come February, that differential started to come down really quickly. So we saw, let's see, I'm trying to remember exactly when the price came down. The peak was very much in January. When, if you look at Singapore prices, for example, $360 difference at the peak in January. February started to come down, and then the spread came down for two reasons. One was that oil prices came down. I mean, we all saw that oil prices came off a high, and they fell very rapidly. And when the oil prices fall down, the price differentials between the highest and lowest prices coming out of the barrel will also narrow, because you're looking at the dollar differential will come down just as a consequence of the oil price itself. But also you saw that the high sulfur fuel oil surplus in the market was disappearing, and the market was adjusting to supply mainly very low sulfur fuel oil. So that spread came down to about $50 by April, May, and it hasn't really recovered since. So that has made the scrubber economics less attractive. I would say that those that have scrubbers on board, they had the benefit of a period with a high price differential. They are still able to run those ships on fuels that cost maybe $50 less than what their competitors are running on. So that's still a plus, but it doesn't make perhaps investment in retrofits as attractive as it has been. The economics of that doesn't really add up at the moment.
In the window and where the scrubbers were clearly the big winners in the first quarter, did that attract more shippers, owners to pursue that solution or not?
It's hard to tell. It would have, I think they were looking at it very, very hard towards the end of the year, and some of them would have still thought they missed the bandwagon early on in the year. But the picture changed so rapidly that before they had time to consider that properly, that the situation had changed.
And COVID had basically blown everything out of the water, so literally in the sense that trade collapsed and shipping rates, although on the oil tanker side, you had this massive contango and ships were suddenly making a fortune.
They did for a while, yeah. it was a happy time for the tanker market. But again, it depends on which segment of the tanker market you're in and what business you're in. So fortunes in shipping fluctuate quite rapidly as well.
When you take all of these pieces, Unni, in the course of this year, 2020, and as they were at the end of the third quarter, that's a lot of volatility for shippers to deal with. I mean, every sector has had to deal with their own version of it, but ultimately, the extra layer for ship owners this year has been the IMO 2020 rule. How has that volatility in its entirety? What do you think are the legacy impact of that on the shipping sector, on the bunkering side of it?
Well, as we were preparing for IMO 2020, what everybody thought, and what indeed we saw at the start of the year, was that for the majority of shipping companies that were going to use compliant fuel, their fuel costs were going to go up significantly. And so that is something they had to contend with. And also for the supply side, that's really rather important, because the marine fuel market runs on credit, unsecured credit, really. So typical credit terms would be 30 days after delivery that you have to pay a bill. It can be shorter, it can be longer. It depends on the relationship that you have with your supplier. So in the supply sector, there was a huge worry about whether there was going to be sufficient credit available in the market, liquidity, if you like. So that concern, of course, dissipated as oil prices came down. So for the shipping sector, at a time when some of them were perhaps beginning to see the market conditions becoming more difficult because of the declining trade volumes, at least they had the help of fuel prices going lower. So in some respects, I think that has been a relief for many. It also made the liquidity problem less of an issue for the supply side. This kind of volatility isn't new, though. Interestingly, we saw something similar back in 2015. In 2015, the sulfur limit in emission control areas, which we have in Northern Europe and around the entire coast of the US of A and Canada, with the exception of some bits up north, that sulfur limit fell from 1% to 0.1%, and that meant that those ships operating there would have a massive increase in their bunker bills, because they would mainly need to go from 1% fuel oil to distillate 0.1. Big price increase was expected. And then what we didn't expect, of course, was that at the end of 2014, oil prices had come off a cliff. So what you saw at the time then was that in June 2014, we were looking at maybe a $300 increase in the price per ton for ships operating in those emission control areas. And then by January, ironically, the gas oil that they needed to buy to be compliant cost less than the high sulfur fuel had cost in June, half a year earlier. So oil market volatility is something that the industry has had to contend with many times.
So on this occasion, it seems that layers on layers. And one of the issues that still seems to linger is the sulfur verification and arriving at some consistency with the new fuel oil standards 0.5. The idea that ship owners would get a consistent blend all over the world. I'm wondering, how has that turned out? And how has verification processes evolved?
Well, the thing about the fuel used now, we refer to it as very low sulfur fuel oil, or VLSFO. It's a blend, and that's not new. The high sulfur fuel that ships were using when the sulfur limit was 3.5% was also a blend. It's very rare that you can take it straight out of the resids productions from the refinery and put it in the ship. It can happen, but mostly these products are blends. Now, what happens when the sulfur limit fell from 3.5% to 0.5 is that the components going into the blend need to change drastically, because previously, if you took the residual product coming out of refineries and you blended it to meet the upper viscosity and density limit, which exists in the fuel specifications, everything else tended to fall into place. It was very rare that you would exceed the 3.5% sulfur limit when you were blending towards those things. Now, however, because 0.5 is so much lower than what was naturally going into the marine fuel pool, the blend components are different, which means that the nature of the fuels has changed somewhat as well. And you're getting a lot more variety than you used to. One of the things that you see most, which is of the biggest concern for operators, is that the viscosity is much more variable. With the fuels that most ships ran on before, they would run on an RMG 380, which would have a maximum viscosity of 380 centistokes. And most fuels sort of would be not too far off that. Now, however, if you order a fuel which is 0.5 and you're ordering it to a 380 centistokes maximum spec, it depends on where you go. You might get a fuel which is close to that spec, but most of the time you will get a fuel which is much lower in viscosity than that, maybe 100. But it can also have a viscosity which is more akin to what you would see in a distillate fuel. So the range is very, very wide. And that's a real challenge for operators to deal with. They need to know the viscosity of the product that they get on board in order to treat it correctly.
Is there anything your organization or others can do to try and sort of arrive at a more consistent standard?
Well, the standard of the product in the market is an effect of the price that of the components that are available to blend. And bunker consumers tend to be very price conscious. They want the best value for money. And so in order to produce that, the supply side then needs to look at which components can they blend to make a fuel that meets the specifications, that is suitable as a ship fuel after the normal treatments on board the ship, because the ship is, as delivered, is not usable. You need to pre-treat it, you need to run it through separators, etc., to clean the fuel and etc. on board. So the fuel is already, as delivered, it isn't put straight into the engine. It goes through a process on board, onboard fuel management, if you like, which I'm not going to go into detail on here. But that variety is very difficult to get away from, because it depends so much on what is coming out of the refineries that you can blend to meet that 0.5 sulfur limit.
And where is the responsibility for the verification, and how is that being done? The sulfur
how is that being done? The sulfur verification.
I mean, in the sense that, is it the MARPOL, or is it commercial practice, or whose responsibility is the verification of the sulfur, and is it happening to a standard that the industry can work with?
Well, when the industry produces fuel, it tends to need to meet certain specifications. The majority of the time, that's ISO 82117, which is an international standard. And that sets specification limits for viscosity, density, cat fines, etc. And for the distillates, there are actually a sulfur limit as well. Now, that spec doesn't actually have a sulfur limit, though, because that's left up to the IMO regulations. So that's a statutory element. So the buyer needs to specify, when they purchase a fuel, whether they want something that meets the 0.5 sulfur limit, which is the global limit now, or whether they want something that meets a 0.1 sulfur limit, which is in the emission control areas, or whether they have a scrubber on board so that they can buy a higher sulfur product. So they need to specify that at a point. It is, of course, up to the supplier to make sure that they have produced a fuel that meets those specifications. So testing goes on before the fuel is put onto the market, and that is the supplier's responsibility. So the suppliers, whether that's at the refinery stage or at the blending stage, will have tested the fuel to see that it meets both the ISO 8217 specs and the sulfur limits. So that's up to the supply side.
was some debate at the beginning of the year that whether the ports would have a responsibility in which to verify and sort of act as the policeman in their particular ports. Has that relationship between stakeholders sort of worked itself out?
Very few ports have been very active in policing that on the supply side. There are supply licensing schemes in Singapore where if suppliers are breaching limits numerous times, that their license might be under threat. I have heard of examples in the US where suppliers have had tank samples tested by the authorities to see whether it meets the specification. But most of the time, the authorities leave it up to the supply industry to get it right. And then what you see is that shipping companies, by and large, test their fuels before they use it. And then sometimes you get an issue with them getting a result back which is not meeting the specifications. And when that happens with sulfur, then of course they get very nervous, because for the ship operator, their concern is whether they are going to end up in a port state control situation where they face a liability for having non-compliant fuel, whether they're burning it or they're having it on board.
Well, there was some issues at the beginning of the year also with ships flushing out their tanks in around ports with heavier fuel before loading with new bunker, which seemed to be a big problem. Certainly in this area of the world, it was. One of the things I wanted to touch on was one of the outcomes of this COVID period has obviously been a massive disruption to aviation. And we're seeing now reports of jet fuel, because it's now so cheap, being blended for use by ships. Can you talk a little bit about that? Is that a minor part of the business? Is it happening more than we know? What's your insight on that?
I've only heard the rumors, just like you, and I haven't really seen the evidence of it happening as such. If it happens, as long as the fuel continues to meet specifications, if that is happening, then it isn't necessarily a problem. It's about getting a fuel that's safe to use and that meets specifications, and there are specifications which needs to be then tested before the fuel is put to use in the marine fuel market. One of the main concerns about aviation fuel might be flashpoint. We have seen from time to time that flashpoint is an issue with marine distillates primarily. That's been the case in the past, but before 2020, and it's still the case today, that whenever you get a flashpoint off-spec episode, it tends to be with marine gas oil rather than the residual type of fuels. And the VLSFOs we classify as residual fuels, and there's been very little issues with flashpoint, the flashpoint limit not being met there. So I'm not sure how much of an issue it is.
Well, it'll be certainly interesting to keep an eye on it. Just to wrap up, Unni, the IMO 2020 is ultimately part of the great energy transition that is affecting the whole world, affecting every sector. And it would appear that COVID, if it's done one thing, has accelerated the initiative behind the energy transition. I'm wondering, from your point of view, what is the consequence of that for your members, for those in the bunker industry? Less shipping, less trade, supply chains maybe even being altered, instead of China into Europe, supply chain solutions being looked at more locally. These are some of the big possible trend changes that could come out of this period. I'm wondering how you see them and how they could affect your sector.
What we have seen already this year is that some areas have seen demand go down significantly, and other areas have seen the bunker demand hold steady or even grow year on year. when we all started realizing that COVID-19 was having a massive impact on oil demand globally, we were looking at the bunker market thinking, okay, when is this going to hit the bunker market? And initially it didn't. It didn't seem to. During February, March, which was the early stages, we saw several ports actually increasing their bunker sales year on year. Also, it seems bunker sales held up quite well during April and May in many areas, although in some of the smaller ports you had started to take a hit then. But there's also been speculation that bunker sales held up well in that period because shipping companies were taking advantage of low prices to fill up their tanks.
Right.
And then in June, that's when we saw the biggest hurt in many areas. It was a real low point. Where even the markets that have held up well and even had supply hold up or even increase year on year saw a dip in June, like for example Singapore. But Singapore year on year has done really well, where some of the ports in the US Gulf had a really tough time in June, July, maybe recovering a little bit. Panama was doing well for a while, and then it had a huge sales dip in June as well, over 30%. But these things can change so rapidly. It's very unpredictable at the moment. You will see some areas benefiting from being the places where ships go to. Maybe they see them as safe havens in terms of good quality of product, service, getting the right quantities, etc. Singapore seems to have benefited from that. Also, some of the ports which have the widest variety of products available, high sulfur fuel isn't on offer everywhere anymore. The majority of the market has gone to using the LSFO, and as a consequence, the ports which don't have a lot of turnover will not necessarily stock high sulfur fuel anymore.
And that trend will probably continue, I suppose, particularly if you're talking about a shrinking market. The IEA numbers and OPEC numbers for the year are about 9 to 10 million barrels of less oil demand in 2020. So from 100, let's say, to 90 will be the consumption this year. Next year, some recovery is expected. But ultimately, most analysis would be that the totality of the oil demand globally will struggle to get back to the pre-COVID levels. If ever BP says not, others say it will in 2-3 years. The totality of the size of the bunker market is very, very likely to shrink.
Yes, that is what everybody's thinking. Even though some ports are managing to hold on or do better, and some suppliers are managing to hold on to their market share or do better. Others are not, and our members, it varies. Some are very very pessimistic and think it will shrink by 20%. Others think it's more like 5% if you take 2020 as an overall picture. And we won't really know until the end of the year exactly how it pans out, but we have already seen a big shrinkage during some months, which certainly will take a chunk out of the market.
What's the IBIA's view in terms of the expectation for 2020, 2021?
What's the IBIA's view?
Do you have a percentage point you think the market demand will have shrink in 2020? 2021?
It's so difficult to put a number on that, and I'm not the fan of predictions because most of the time you get them wrong.
There's no harm in getting them wrong. People forget what you ever said, but ultimately, I suppose that's quite a range. Some of your members saying 5%, some saying 20%.
Yeah, there is a big range. So much will depend on how the market is reacting to COVID going forward. I mean, at the moment, we're going back into sort of a lockdown Mark II in the UK, for example, where I'm based. But it's different from before. So maybe the demand, trade demand. I mean, ultimately, bunker demand depends on shipping trade. How many ships are being taken out of service? For a while, initially, for example, in the container trade, you saw empty ships doing empty sailings. they still use bunkers then, but when they start taking the ships out of service, then you get less bunker demand. So, I mean, just if putting me on the spot and taking a mid-range of what our members are seeing, maybe a 10% decline overall in 2020.
I suppose in comparison to the global crude market, which is 10%, according to IEA and OPEC, maybe the bunker will be a comparable number. We'll have to wait and see. But yeah. Unni, thank you so much for your time and for participating on this week's Halftime Talk. It's really important to get a deep insight as to where bunker industry is going as it's part of this wider global energy markets industry. So thank you very much for your time today.
Thank you for having me, and have a good afternoon.